Welcome back. You're with us on Trading Hour, and the market continues pretty much to be in steady form, though we've given off a little bit from the top of the day. So let's get some perspective going. We have Jyotivardhan Jaipuria, founder and MD of Valentis Advisors, with us now. Jyotivardhan, always a pleasure having you on the show. Thank you very much for joining in. First things first, as the market is trying to inch its way back to all-time highs, let's take stock of what you have made of the corporate earnings season. I mean, at least we haven't had that whole series of downgrades that we saw in the third quarter. But do you think earnings have enough muscle in them as we go down the year to support markets at present levels and perhaps even higher?
Yeah, so, when we started the earnings season, we were expecting earnings for this season to be around 15% for this quarter. Now, obviously, there were a lot of skewed things because one is if you remove the banks, then the earnings growth comes down to only 5%. But if you remove the global commodities, earnings growth goes up to 23%. So there were two sectors which were, weighing on earnings in a big way. One on the positive side, which is the banks, one on the negative side, which is the global commodities. And the other sectors were somewhere in between doing fairly okay. So far, what we've seen is earnings broadly in line to slightly better than expectation. So to that extent, it's more or less where it is. We think for the rest of the year, for this fiscal year 24, we're probably going to get something like a 10 to 12% earning growth, maybe a tad lower than what the street is building in at the moment. But 10 to 12 will be good in a global context because you probably will have, whether you have a economic recession or not, I think we'll have an earnings recession in the world. Probably, US will be flat to negative earnings growth, and a lot of other countries will do that also. So India's, 10% will stand in good stead in some sense.
Jyoti, pharma is a sector that you're increasingly getting interested in. And in that, Mankind Pharma just listed today, robust listing, 27% higher in the stock. Did you look at the IPO? Did you invest prior to the IPO in the book? Or are you looking to buy it now in the secondary market?
Reema, the way we looked at, the pharma sector is the three elements to it. One is the domestic pharma, which we have liked in general, and we have a few names over there. The second is, we look at the crime space, which again, we have liked. The third is, the US generics, which we have stayed away from for a long time. Like, I don't think we've done this in the last 5 years. Where things are changing is the US generic. I think we are getting on the margin a bit more positive on the US generic space, because essentially over there, you had like a constant price drop for the last few years. That price drop is probably coming close to an end. Prices are not going up, but at least they're starting to plateau off. And so, the negative growth which we saw from US generic side may not be there. So a lot of companies which got hurt badly because of negative growth over there may start seeing flattish growth then. So if the rest of the business does well, they'll start to do well. So actually, we are now looking at very closely some of the stocks which are probably in the US generic space. We continue to own domestic pharma, but there are a couple of other names which we have held for a long time, which we like.
Okay, got that. You have been telling us that the overall theme is still to avoid the global space completely and look at local. Within local, there have definitely been these few sectors that have stood out, right? The likes of railways, defense. Do you think these are good bets even at these prices, or do you think the run-up has already been too high and perhaps we need to wait a bit now on these?
Yeah, so, like over the 5 years, 3 year, 5 years, these are still good bets. What's happened short term is now, the short-term margin for error is a little high. So, if there's a miss on the street or if something gets delayed, then you'll probably start seeing it. So we always prefer to buy a lot of these stocks when they go down rather than when they are rallying up. Because see, what will happen for a lot of the defense stocks is their orders, now they have to execute. And the execution cycle is long. It will take time to execute. It won't get executed to perfection. And so to that extent, you'll probably keep having quarters which disappoint. And you probably want to buy the bad news there rather than buy stocks which are 50% already. But it's still a theme which over 3 years, 5 years is going to do very well. Like the defense companies in India are going to get much, much bigger than what they are today. And, they'll probably all be double of size. There'll be a lot of new listings also you can play through on it.
Jyotivardhan, defense, pharma, those are some of the ideas that you've shared with us. Anything else, since you're looking to identify more inward-facing businesses, anything else, perhaps beyond, the Nifty 50 or the Nifty 100, that's catching your eye?
Yeah, so one theme which we've been playing is there are a lot of sectors which got hurt last year because the commodity prices went up. And now that the commodity prices have come down, the margins which had fallen by maybe 300, 400 basis points in FY23, they will probably revert back to mean in FY24. We could get like a 300 basis point margin increase. So, some of these sectors, one would be, the ceramic sector, where gas prices are shot up, gas prices are constantly coming down. So though demand is weakening a bit from where it was last year, we'll probably still see a substantial margin expansion which helps these sectors. Another one would be like cement, which is probably like more well known. So in cement, we're not really getting too much of price increases in cement. But for most companies, because raw material prices are coming down, you probably have 150 to 200 rupees EBITDA per ton, which is going to go up just because of cost saving. And that will add to it. And we've already seen some of these cement companies announce results, and that is played out. The third one would probably be the wire and cable space, where again, you've seen some decrease in commodity prices. So this is one theme which I think will be very interesting this year, where you get a big margin uptick coming and margin normalization happening.
Okay, Jyoti, out of time. Thank you very much for joining in. Need to slip into a very short break. On the other side, we'll talk about the disruption in the food delivery space. Will ONDC disrupt things? A very interesting analysis coming up on the other side.